So let's further explore why global diversification matters and how it's possible to achieve smoother compounding returns across market cycles when you have this global exposure. Also, I suppose, with my next guest, how to identify some world-class businesses that are deserving of your attention, and how to reduce reliance on single sectors. So think banks and miners here in Australia. And to do so, Alan Pullen from Magellan joins me now. Alan, a very warm welcome. Nice to see you.
Nice to see you again. Pleasure to be here.
It's a simple question, I guess, but why does global diversification matter for Australian investors now?
Well, it's mattered for some time, actually. If you look at the returns of global markets, they have been ahead of Australian markets for a number of years now. Now, we know why this is the case. You just mentioned it. Australia is dominated by, some would say, more old world sectors. Think about miners, think about the banks. When we look internationally, where's the big growth coming? It's not really in those sectors. It's coming from the big technology sector, coming from the big US tech companies, but also companies in Europe and Asia are contributing to that. And if you're only focused domestically, you're really missing out on a big part of both global growth, but also industry growth, different industries growing around the world.
So what kinds of companies, is there a particular kind of company that the Magellan Global Opportunities Fund looks to invest in?
Well, we're really focused on high quality companies. So we think quality is really what differentiates from Magellan Company to the wider index out there. And high quality companies have a couple of big advantages for investors. One, they are systematically mispriced by the market because the market tends to think short term and we think long term. And over the long term, those quality companies deliver compound growth. So you get actually better returns over a long time. And because they're quality, they tend to do quite well in downturns as well. So you get lower risk and higher returns.
So quality, how does Magellan define quality and measure quality, I suppose, in the companies that you're selecting for the fund?
Yeah, that's a really good question because it's easy to say that, but what does it actually mean? And it means different things for different people, to be honest. Some people look at an index, for example, and it's earning stability and balance sheet strength. We take a very different approach, a very forward-looking approach. And really what we're trying to do is identify companies with strong competitive advantages, and we find out what's the source of that competitive advantage, and most importantly, the duration of it. How long is that going to protect them so they can protect their profit pool and grow it over time and grow the shareholder value. So there could be a number of different kind of things to competitive advantage. It's different for different companies. For somebody like MasterCard, it's a network effect. That payment scheme is only useful if there's a lot of people accepting MasterCards and a lot of people wanting to pay. And it's very hard to break that network effect. For others, it's scale and brand, like Nestle. For yet others, technology leadership, like TSMC in semiconductors, for example. So it's particular to every company, and it's forward-looking.
Why, though? Why does quality work across cycles?
Look, it's a good question. Quality tends to be undervalued systematically by the market. I touched on this earlier, and I think it's because most of the market either doesn't care. So one, think about passive flows. They don't care about quality. They just go into whatever's big at the moment. Two, I would say it's very short-term focused. Very focused on the here and now, the news cycle, what's hot, what's not, what's next quarter's earnings going to look like. Whereas quality doesn't matter in that short-term time perspective. But if you're thinking 3 years from now, 5 years from now, 10 years from now, what's going to make the difference? It's quality. So quality tends to deliver that long-term compounding growth, and the market just is focused on the short term. And so it's systematically mispriced and gives you those long-term excess returns.
We had a guest earlier talking about economic moats, saying that the notion of moat, in his view, is sort of evolving and changing. Do you look for that moat, and how do you define it?
Well, that's a good question. So when I was talking about competitive advantages that companies have, now how Warren Buffett, when he talks about moat, that's kind of what he's talking about. He's talking about what is those competitive advantages that's going to protect that company from competitors coming in and taking their profits effectively. That's how capitalism is supposed to work, right? Okay, you're supposed to make high profits. Another company will see it, they'll come in, they'll undercut you, and your profits will go away. So what are those competitive advantages that actually allow you to protect and grow that profit pool over time? Now, some elements of moat have remained static over time. Now, if you've got huge scale advantages, if you've got a concentrated industry structure, those are still real advantages over time, but others have eroded over time as technology comes in and other forms of moats are kind of needed to protect those profit pools. And we talked about digital. Often that's a huge network effect, which is why we really like those network effects. They're more important today than they've ever been before.
Okay, so MasterCard was the example of that. How does this Global Opportunities Fund fit into sort of a core satellite structure for investors? And I'll ask the question that many of our viewers are now saying, like, what does that actually even mean?
Okay, so this is how a lot of kind of fund managers or kind of professionals will allocate a portfolio. And they'll have a core portfolio which will give you index plus, and then they'll decide on a kind of factor exposure to kind of complement that. And maybe that's high growth stocks, maybe that's deep value, maybe that's an India fund or what have you. When I think about quality, because of those characteristics I talked about earlier in terms of its long-term compounding growth, and it's not correlated, for example, with growth necessarily, not correlated with value. It is its own unique factor, and we've got a lot of evidence over the history that it structurally outperforms. Kind of growth will have its time in the sun, value will have its time in the sun, but quality structurally outperforms over the cycle. And that's why it makes such a good kind of core holding to base your portfolio around.
Right, okay, thank you. A question has come in, and we've had a lot of questions sort of along this line. Rob, thank you. He's saying, I've only had ETF exposure to global. I hate to make you speak for the whole industry, but why managed funds over ETFs? Why this fund over ETFs?
Okay, it's a good question because it is a good way for a beginner to get broad exposure to the globe. And typically an ETF will track the MSCI World Index, for example. That's got about 1,600 companies into it, so you get a very broad exposure. But what that means is you're getting the good and the bad. You're getting the overvalued and the undervalued. And what we can do with a managed fund or an active ETF, if you like, we have some of those as well, is a more curated exposure. We can ensure that we're in only the highest quality companies, which outperform over time, and leverage to the most attractive industries and geographies over time. And so you'll get a different risk and return, and we think a superior risk and return to those broad-based ETFs.
So here's a question. How does the investment team at Magellan narrow down 1,500 global stocks, which I guess is your investable universe, to 200, and then go from there to 20 to 40, correct me if I'm wrong, in the portfolio?
Right. Yeah, no, great question, because there are a lot of stocks out there, and we go down to around 200 of what we consider high quality companies. And we go through a rigorous process, and this is assessing the industry, the company, its competitors, for those comparative advantages that they have, and stressing them. What could erode those over time? How durable are they? And then we think about things like business risk, reinvestment potential, agency risk and quality of management, and only about 200 companies kind of pass that filter when we run that filter over the index, and it has to go through an investment committee to be considered available for investment. Of course, that's just quality, and then for constructing the portfolio, we think about quality, intrinsic value, so we've got to make sure these companies are also attractively valued, and risk, and that gets us down to that 20 to 40 stocks, typically around about 25 to 30.
I think you sort of answered my next question. So valuation does play a role alongside quality when you're selecting stocks.
Look, absolutely. Now, quality gives you a really good starting point, but even the highest quality companies, they can be poor investments if you overpay. And we're very disciplined around intrinsic value. We think the market gets value wrong all the time. And this is more than a simplistic metric, a PE ratio, for example. You've actually got to understand what the intrinsic value of that company is. That requires a lot of work work that we've done assessing the quality, luckily, so we can come up with a sensible view on what the intrinsic value for a company is, and that's, that could be quite a high headline PE as long as it's justified by the growth and quality of that company, and then we buy at a discount to that intrinsic value.
Mm-hmm. So I'm going to be a bit cheeky here, Alan, because the question has come in from Sophie saying, well, would you ever be tempted to buy NVIDIA? Because I think it's been made public that you don't actually own NVIDIA.
That's true. We don't own it. And look, it's tempting, right? I get it. It's very tempting. It's a high quality company. We cover it, so it's passed our filter process. It benefits from AI. We're big believers in the long-term kind of benefits that Gen AI can bring to companies in that industry. But for us, taking that long-term view, there's still a very wide range of outcomes. So it's the intrinsic value area that it falls down on at the moment, and kind of the risk. Why? Because yes, they're doing very, very well now, but when we think ahead 3 years, we know their biggest clients are building their own chips to do Gen AI. That's the hyperscale cloud platforms, Microsoft, AWS, and Google Cloud Platform. They are building their own chips. So those might become more competitive. We are getting more efficient models. We expect that to continue. And while we expect the take-up of Gen AI products to be solid, we don't know if it's going to be enough to overcome those headwinds. So there's a wide range of outcomes for NVIDIA. Just on where it's trading at the moment, we can't get comfortable with that longer-term picture.
Yeah, so it's not just value. It's not just that it's an expensive stock right now.
Look, it's trading at around 40 times earnings.
Yeah.
So it is certainly pricing in significant growth. There are scenarios where it will get that, and the next quarter seems fine, obviously, but there are scenarios we'll get that. But there's also a range of scenarios where it's significantly undervalued. It just has a much wider range of outcomes.
So just quickly, I mean, we've talked about, I guess, risk mitigation in the process, but you can still achieve outperformance while mitigating those risks, even with US markets in particular at these sort of all-time highs?
Yeah, look, absolutely. Now, we can get outperformance in up markets and in down markets. I think what you're alluding to is with US markets and global markets, to be honest, are fairly high, elevated levels relative to history. And I'd agree with you. Things are a little bit fuller valued at the moment. So the portfolio has delivered 20% plus returns the past 3 years. The market is delivering kind of very high levels of returns. We'd expect that to be more modest going forward. And if something does happen to go wrong with economic growth, with interest rates, there's some potential downside there. But quality is going to protect you on that downside, because when something goes wrong in markets, it tends to be those low quality speculative companies that get hit hardest. So in a relative sense, it will still protect you.
So you name dropped some of the stocks earlier on. We did have a graphic with some of the top 10 holdings. So global sectors, trends that you're currently positioned to benefit from. You mentioned AI, so you're a believer in the transformative power of this fourth industrial revolution. Do you look to any other sort of key thematics?
Yeah, within AI, we're certainly, we're a bit nervous on the semiconductor center, but think about the semiconductors are the first part of AI. Then there's the platforms where people operate these models, and we're still very positive there. I mentioned the hyperscale cloud platforms. And then there's the application layer at the end. So we still think there's room to play in those latter two parts of the Gen AI. Certainly we also benefit from we're always looking for these long-term tailwinds. So, the aging of the population. In the West, the population continues to get older. They need more healthcare. Yeah. So that's another tailwind.
But you might look past sort of it's hype around, say, the defense sector. So you're not chasing, these thematics that come up.
No, not short-term thematics. Yeah. So, your view on we're very confident of Gen AI over the long term. We're very confident of compute intensity over the long term. We're very confident that people are aging, right? These are kind of very well-known tailwinds that are going to last for not 1, 2, 3 years, but for a decade from now. Something like defense spending. Now, if we could find a very high-quality company, we would get exposure to that happily. But it's harder to find these high-quality companies. They are dependent on government contracts. That spending comes and goes depending on the cycle. So we're not looking for short-term tailwinds. We want those long-term compounding tailwinds.